Hey, hello everyone. It's Terry Bontemps. Hey, welcome back to the channel. In the San Francisco Bay Area, even the most beautiful condo communities are hiding a financial truth that most homeowners and new buyers never see until the new federal mortgage rules expose it. Starting August 2026 and tightening again in January 2027, Fannie Mae and federal regulators will require every condo loan to pass a full financial and structural review of the HOA. No shortcuts, no limited review, no don't worry, everything is fine. And this is exactly where the collapse begins. Because behind the landscaping and fresh paint, HOAs across California, including mine, are carrying underfunded reserves, rising special assessments, and budgets that only look balanced on paper. I know this because I lived inside one for 8 years. I was the chair of the Budget and Finance Committee until the board and property manager canceled me. Because I had questions about the lack of financial transparency, I watched the reserves fall, the liabilities grow, and the special assessment risk build while the outside looked perfectly normal. That experience is why I'm teaching homeowners and buyers how condo financial collapse actually happens and why these new federal rules will expose it nationwide. And it's why I built HOA TrueView, a technology platform that gives homeowners and new buyers instant visibility into the real financial stability of their HOA. Not the brochure, not the sales pitch, not the approved budget, the truth. The same truth federal lenders will now require. So, let's break down what's really happening inside my HOA and why the new federal rules make these numbers impossible to ignore. What you're about to see isn't theory, it's not a hypothetical, and it's not a scare tactic. This is a real California HOA. My HOA and its financials show exactly how condo communities collapse long before homeowners ever hear the words special assessment. I'm showing you my HOA because it represents the same pattern happening across the Bay Area and across the country. Reserves that look stable until you read the footnotes. Operating budgets that balance only on paper. Millions in deferred repairs. And a reserve deficit so deep that special assessments become unavoidable. These numbers matter because they're the exact red flags federal mortgage rules will start screening for in 2026 and 2027. If an HOA looks like this, buyers won't qualify for loans, owners won't be able to sell, and the community enters a financial freefall. And for current homeowners, this is the part that nobody tells you. Boards and property managers will not warn you months or years in advance. They won't tell you a $15,000, $25,000, $35,000, and even more special assessment is coming. You'll hear about it after the vote, after the reserves run out, and after the emergency becomes unavoidable. That's why I became a founder. That's why I built my tech startup, HOA TrueView, because homeowners deserve to know the truth before the collapse hits. HOA TrueView shows you when special assessments are likely to hit, where the financial red flags are hiding, how underfunded your reserves really are, whether your HOA is stable, drifting, or already in crisis, and what the numbers mean for your property value and your wallet. Now, let's walk through my HOA's actual financials line by line so you can see exactly what homeowners are never told and what HOA TrueView reveals instantly. Based on my HOA's own 2025-2026 annual budget and reserve disclosures, it is operating with a reserve deficit of a negative $3,938,000 at the start of the fiscal year. It's the estimated cash reserves of $2,879,000 minus the estimated liability, which is $6,817,000. Only 42% funded reserves, which is considered high risk under California reserve standards. A required 10% annual increase in reserve contributions for the next 30 years, followed by 8%, 5%, 3%, and 2% increases through 2055. Dues start at $591 a month for a one bedroom in 2025, and in 2055, the dues will be $1,661. The old board's plan was painful, but it was mathematically honest. The new board, They eliminated the 30-year plan entirely, which means there's no long-term reserve strategy, no gradual increases, no roadmap, no transparency, and no way to avoid special assessments. And the new board did it with no financial transparency or town hall meetings to inform the members about the new budget. When you remove the slow, predictable increases, you guarantee large, sudden, unavoidable special assessments. This is why my HOA is now in the danger zone. Forecasted reserve expenditures of $1,419,000 in 2026 alone, far exceeding reserve income. This means the association does not have the funds to meet its known obligations without future special assessments or significant dues increases. Reserve funding risk, high probability of special assessments. The association begins the fiscal year with a negative reserve balance of $3,938,000. Required future increases. The reserve study requires 30 years of continuous annual increases to avoid collapse. This is an explicit admission that current dues are insufficient. Forecasted expenditures. The association expects to spend $1,419,000 on major repairs in 2026. The reserve income is only $847,680. This creates an immediate $571,320 shortfall in the first year alone. Buyer impact. Buyers should expect special assessments, rapid annual dues increases, deferred maintenance risk, reduced property values due to financial instability. Operating budget red flags, insolvency indicators. Operating fund has no cushion. The operating fund ends the year with zero surplus. This means no margin for emergencies, no ability to absorb cost overruns. Any unexpected expense forces borrowing from the reserves. The association is already using reserves to cover the operations. The budget shows operations revenue, $836,654. Operation expenses, $836,654. This perfect match is known indicator that the operating budget is artificially balanced. Any real-world variance forces reserve transfers. The association is functionally insolvent on the operating side. Structural financial risk. The reserve liability is growing faster than the funding. The reserve liability grows from $6,817,000 to $10,072 in 10 years. This means the association is falling further behind each year. Even with aggressive dues increases, the gap widens. Long-term financial stability is not achievable under current conditions. Buyer risk, deferred maintenance and component failure. The association lists major components requiring near-term replacement. Site fencing, $505,000. Asphalt and concrete, $380,000. Residential building repairs, $158,000. Exterior painting and repairs, $94,000. Irrigation and landscaping, $84,000. These are not optional. These are not nice to have. These are critical infrastructure items. The association does not have the funds to complete them without borrowing, special assessments, emergency dues increases. Buyer risk, long-term dues escalation. The reserve plan requires dues to increase every single year for 30 years. This is not a projection. This is the association's official funding plan. Buyers should expect dues increases well above inflation. Long-term affordability issues, difficulty reselling due to financial instability. Buyer risk, insurance exposure. The budget allocates $106,000 for insurance. Given statewide HOA insurance volatility, the number is likely understated. Future increases may be substantial. Underfunded reserves amplify insurance risk. Buyer risk, litigation exposure. Underfunded HOAs face construction failures, emergency repairs, owner disputes, potential lawsuits. The association financial condition increases the likelihood of claims, special assessments to cover legal costs. Required disclosure statement to buyers. Based on the financials provided, this is the message that the board, management, and realtors should be obligated to disclose to current homeowners and new buyers, but they don't. The association's reserves are significantly underfunded. The association begins the fiscal year with a reserve deficit of $3,938,000 and is only 42% funded. The association anticipates major component expenditures of $1,419,000 in the coming year, which exceed projected reserve income. The association's long-term reserve plan requires annual increases in assessments for the next 30 years. Buyers should anticipate future special assessments and substantial increases in monthly dues. Conclusion: why a buyer should not purchase and why current homeowners should be very concerned at my HOA. Based solely on the association's own 2025-2026 annual budget, my HOA is financially distressed. The reserves are deeply underfunded. Operating funds are barely solvent. Required repairs exceed available funds. Dues must rise every year for 30 years. Special assessments are highly likely. Property values are at risk due to financial instability. A prudent buyer, lender, or underwriter would classify my HOA as high risk. Let's talk about the impact of new federal mortgage rules. My HOA will become non-warrantable. Beginning August 2026 and tightening again in January 2027, new federal mortgage rules require every condominium association to undergo a full financial and structure review before a buyer can obtain a federally backed mortgage. These rules evaluate reserve funding levels, reserve deficits, deferred maintenance, structural repair obligations, special assessment risk, operating budget solvency, long-term financial planning. Based on the financials presented in this report, my HOA will not meet the new federal lending standard. My HOA again shows $3,938 in reserve deficit, only 42% funded reserves, $1.4 million in immediate repair obligations, no operating surplus, a 30-year pattern of underfunding, high probability of special assessments, a reserve liability growing faster than contributions. Under the new federal rules, these conditions classify an HOA as high risk and therefore non-warrantable. What non-warrantable means for homeowners and buyers: when a HOA becomes non-warrantable, buyers cannot obtain conventional loans. FHA and VA loans are denied. Only cash buyers or high-risk portfolio loans remain. Property values decline. Days on market increase. Owners become financially trapped. Special assessments accelerate as reserves collapse. For many homeowners, this results in inability to sell, forced price reductions, financial hardship, increased likelihood of foreclosure. My HOA is already showing the financial indicators that federal lenders will flag automatically once the new rules take into effect. Why homeowners must prepare now? Current homeowners need to financially plan for upcoming special assessments. Boards and property managers rarely disclose these risks early. Homeowners typically learn about a $15,000, $25,000, or even $35,000 special assessment only after the vote, when the emergency is already unavoidable. My HOA financials show that special assessments are not hypothetical. They are mathematically inevitable. Why I founded HOA TrueView. This is exactly why I became a founder and launched my technology startup, HOA TrueView. Homeowners and buyers deserve to know when special assessments are likely to hit, where the financial red flags are hiding, whether reserves are dangerously underfunded, how federally mortgage rules will classify their HOA, whether their property is at risk of becoming unsellable. HOA TrueView gives homeowners and buyers instant visibility into the true financial stability of their HOA, not the appearance, not the brochure, not the sales pitch, just the truth.